Welcome back, everyone. This is Mortgage Sensei. Our next discussion is going to be in regards to PITI. PITI, right? First thing, Nelson, what is PITI? PITI is your housing payment, right? Your monthly housing expense, to be more specific. Now, let's put this down. Monthly housing expense. Okay. All right. Why should you know what PITI means? Well, a couple of reasons, right? First, you want to know what your PITI is because this is what you're paying per month. Is what you pay. It's what you're going to pay per month for the home in which you're going to be buying, right? That's number one. That's having to do with you. Okay. Now, the other reason we want to know what PITI means is that this is your qualifying, or AKA your housing expense. Qualifying housing expense. Now, in some of our videos, which you may have watched, we talked about your front end ratio and your back end ratio, right? Or your debt to income ratio, front end housing, debt to income ratio, back end ratio. Now, just talking the front end housing ratio. Now, the back end includes the front end and the back end, but the principal, interest, taxes, insurance, community dues, association dues, so on and so forth. The housing payment broken down into a monthly basis is what is a qualifying ratio when the underwriter is reviewing your file for final approval, right? Now, we'll have a video in regards to who this person is, why they're there, how how you can help the process or help the underwriter. You know, you don't want to be resistant to the underwriter unless the underwriter doesn't know what they're talking about. Most of them are really professional and they know what they're talking about, but they can never argue with the guidelines, right? Unless it's lender overlays. They can't argue with the lender overlay guidelines. Okay, now, so let's talk about how, right? How can I understand the principal, interest, taxes, insurance, right? So first, let's break them all the way down. Let's break down the payment completely. First, let's talk about principal. I do numbers, I don't do spelling. So let's talk about principal, right? The principal is the portion of your payment, that you're making per month to pay down the balance of your home. So we'll just put balance. Okay. It's a portion of your payment that is paid to pay down the balance of your home. Now, you'll see this number, if you're looking at your mortgage statement, it comes every single month. You'll see this number slowly change from one month to the next. At the early stages of your loan, right, your first month payment, you're going to be paying more interest than you're paying in principal, especially if you're going with a 30-year fixed mortgage. If you're going with a shorter term, then this doesn't apply. But most people go with a 30-year fixed mortgage. So you're going to see that you're paying more interest than you're paying in principal. And then next month, you're going to see a little bit more principal is being paid, a little bit less interest, and so on and so on and so forth, right, as you go. Next, let's talk about interest, right? Interest. Okay. Now, when it comes to interest, this is the money that you're paying to the bank, to the lender, for you getting a loan for them, right? So you go to ABC Bank, right? You say, ABC Bank, I need $400,000 to buy this home. ABC Bank goes to the qualification guidelines, so on and so forth, say, okay, you're approved, you're final approved, you're cleared to close, right? We schedule closing, and now you go to the closing table, you sign, you own the home, right? Now, for the process or for the cost of doing business, right? ABC Bank has said, hey, you're going to pay us back the principal balance for the home plus interest or plus additional revenue, cost, whatever you want to call it, but it is interest that you're paying back. So this goes to the bank, right? The balance is you're paying down, you put in the equity, right? And then the interest is going to the bank. It's that simple. Now, for a quick crash course in regards to what an interest rate is, right? Because I was going to do this in the next section, but I could probably knock this out real fast. So, what is an interest rate? All right, an interest rate is just made up of two things only. Two things. It's made up of the index, right? And then it's made up of the margin. Index and margin. Okay. Now, when we talk about the index is like the U.S. Treasury bond, right? LIBOR, right? What we're saying is that this is the let me kind of simplify this. All the gurus out there that's probably watching this, I know I'm not going to say it exactly right, but I'm trying to help those that absolutely don't know what they're looking at or talking about, or what I'm talking about. So I'm going to just dummy this down as much as possible. An index is what the Federal Reserve is saying the cost of money is, right? So right now, at the time of this video, right, there's a lot of media coverage about the Federal Reserve raising the federal funds rate, right? Now, the federal funds rate, it does affect the index to a certain point, right? But that's not it entirely, right? But we're just going to keep it simplistic. So this is what the government is saying that the interest rate should be, right? This is what the government is saying what the interest rate should be. The margin is what the lender's profit, or what the lender's cost is, broken down as an interest rate. So your total interest rate is a combination of an index and a margin, right? Now, why am I saying this? Because brokers are better, right? Our margin is nowhere near what most banks, direct lenders, right? I beat them day in and day out, okay? But when you get in contact with the broker like myself, just know automatically our margin is lower than probably 85%, if not 90% of the competition out there, right out the gate, just because you got in contact with the right person. Then from there, you start talking about, how to structure a loan and get qualified. All right. Now, so we talked about principal, talked about interest. T stands for property taxes. Okay. It's the property tax on the home in which you're buying. That's what the T stands for, taxes. Okay. Now, again, property taxes is more of an insurance, right? I know I'm not saying it's a homeowner's insurance and hazard insurance, but it is a protection on the investment that you make, which of you buying your home. What do I mean by that? Well, if you're buying a home and it normally is in a favorable or desirable area, your property taxes may be a little bit higher. Why? Well, your property tax is a little bit higher because you have better amenities, meaning what? You have better roads, you have better school, you have better health care, right? Or hospitals, you have better, police, better fire department, public servants, right? All of this is paid through the taxes that they collect in the area, in the county, in the city, in the town, so on and so forth. So your property taxes, though they may be high, right, or not, right, just understand that they are what equals protection on your investment, right? The more taxes you pay tends to equal better living conditions, right? The less taxes you pay, if you're living out in the country or living in a rural area, right, you may not pay that much in taxes, but do you have a lot of stuff out there? Okay. All right. Next things next. So let's just talk about property tax. Property taxes goes to the county. Right. All right. Now let's talk about insurance. Okay. Insurance. Insurance include hazard insurance, flood insurance, wind insurance, right? Any other insurance that you get that protects your home from an act of God. that happens directly to the home, not you, to the home, right? Um, that insurance, again, is based off of whatever you qualify for or whatever insurance company you should go with. But that's paid to the insurance company. Okay, insurance company. Now, again, PITI, that's not all of it. So I'm going to add more of what's included in the PITI. Okay. The next thing that you may have is PMI or MIP. Okay. PMI or MIP. Now, this is another type of insurance, right? This insurance is for the protection of the lender in case you default or go into foreclosure on the home. Then the lender or the bank has to go through the foreclosure process, which means they're not earning interest, and it's going to cost them money and legal fees and time in order to take the property back and list the property to be sold on the open market. So this insurance protects the lender in order for them to be able to liquidate and to stay in a process of doing business with the public, meaning that I can't go lend to John over here because Kevin. And if you're John and Kevin, you're good, you're awesome, bro. But I can't lend to John over here because Kevin defaulted and foreclosed on his property. Now I can't get money to John because I got to take the money I was going to give to John and I got to go clean up Kevin's mess, right? So that's literally what private mortgage insurance and MIP is. Now, for those that get the rap that PMI and MIP is bad, it's an ugly thing, you're right, right? Be honest, you're right, but it's a necessary evil, right? It's a necessary evil, meaning that if you can't go with a conventional loan or you're not eligible for a VA loan, right? Because VA loans don't have PMI. But if you can't go with a conventional loan and put down somewhere between 10% to 20% as far as a down payment, PMI and MIP is a necessary evil in order to help you get into home ownership. And in all actuality, if you want to compare what you pay per month for PMI, MIP, and what you pay per month for interest to what you pay in rent, there's no comparison. Absolutely no comparison. And we'll do a bonus thing at the end so I can prove my point here. Okay. Now let's talk about the next thing. Community dues, aka homeowners association dues, aka HOA dues, right? Now you'll see this normally with condos, townhouses, and some single family residents. I have yet to seen it in regards to a manufactured home outside of land leasing or renting the land. But without getting super technical here, you have a homeowners association dues. Now, what is that? Well, homeowners association dues is basically you're paying for additional amenities or cares to your neighborhood and or property, right? So let's say you're buying a home in a development type of area. You got a bunch of houses in a neighborhood, right? And you got a pool there, a community pool. You got a community play area for the kids, right? Maybe basketball, tennis court, something like that, a park, right? And then there's a company or a crew that comes by and keeps everything clean and all of the brush and all of the landscaping looking good, right? Well, everybody in the neighborhood is pitching in on making sure that those amenities are maintained. This is outside of property taxes, right? Outside of so the city, the county, what I'm saying, those they're not out there doing this, right? This is the community working together, and they're pulling all of their money together in order to make sure that their amenities in their neighborhood is being properly cared for. Okay, so again, the necessary evil. If you want to live in a neighborhood where all of that is taken care of, where you can go to your pool or whatever, and it's clean, it's well maintained. Right now, your HOA manager, whoever's in charge of it, is very important there. Make sure you show up to your HOA meetings as well. Make sure you get stuff addressed. Maybe there's roads and stuff like that need to be added or updated to fix or whatever the case may be. But that's what the HOA is all about. Okay. Again, this is paid to the association, right? The association, or whoever that legal entity is that's created in order to make sure this is maintained. Okay. So that is that there in full, right, is your PITI broken down completely. Now, for those that stayed with me through this video, I got something bonus that I want to do real fast. Okay. Now, I mentioned earlier that when you're looking at principal, interest, or your monthly payment when it comes to your house, okay, versus renting, that there's no comparison. There's no comparison, right? Let me show you right now. Okay, so let's put on this side. Let's do it like that, right? And let's put over here rent. And then let's put over here home owner. Okay, renting versus home ownership. Now, understanding the way I just broke that down, when you compare the two, again, there's no comparison. First, let's talk. We can use the same monthly payment. Okay. So the monthly payment over here, let's say your rent payment. Oh shoot, you're out here in Atlanta. Let's be a little bit more realistic. It's $2,500 a month, right? And then you buy a house, and your housing payment is $2,500 a month. Okay. So on the surface, you'll say, "Oh, Nelson, I'm paying the same exact thing, bro. There's no difference, right?" Not true. Okay. So let's talk about this rent, right? So you're paying $2,500. That's just the rent. What do you have to have on top of that? You have to have renter's insurance. Renter's insurance. So the renter's insurance is probably like, let's call it another, I don't know. Let's be generous and say another $100 a month. You pay another $100 in renter's insurance. Some people paying more. Whatever it is, you can follow along with your own personal calculations, and let's blow your mind real fast. Okay. So $100 a month. So now you're up to $2,600. Okay. Now again, let's talk about what PITI is really broken down. You have your principal, your interest, your taxes, your insurance, your community dues, right? So what are we talking about? Okay. Now your rent is $2,500, and then you're going to be paying renter's insurance, which is $100. But everything is included over here at $2,500. Okay. Now let me make it even more nicer for you to understand. So this money right here, this $2,600, it scratches. We'll take this off for now, but just let's talk about the $2,500 only. When you pay $2,500 to the landlord, to your landlord, right? You are paying them to use their house. You're leasing, right? You're paying in order to use their house, right? So this here is 100% interest. It's 100% interest. Why is this important? I'll show you why. So over here, right, with the homeowners, with a homeowner, right, and I'm gonna try to break this down a little bit. It's not exact, depending on your rate and so on and so forth, term and so on and so forth. But here's some principles that we do know. Principle. Inside of this, right here, we have principal, we have interest, we have taxes, and we have insurance. Okay, we have all that inside of that payment. Okay. Now, Interest is money that's going out that doesn't come back to you, right? It's money going out and there's no return on that money besides you borrowing or utilizing that money. So when you're renting from a landlord, right, you're paying out that money, but the only thing you get back is the ability to use their house to live in. That's exactly what's happening there. Okay. Now, when you're talking about home ownership, you own the home and you're paying the same amount. You're just paying it to a lender now. Here's the difference. Okay. So insurance is paying out, it's no return, right? Taxes, you're paying out. The return is the amenities, right? Good schools, good roads, public servants, so on and so forth, right? So there's the return, but you get the same type of return over here, depending on where you live, right? Interest, you're paying out, no return, right? You're paying the lender premium in order to use the money from the bank, but the principal, there's your return. And most people forget about principal and how that is important. So let me explain to you like this, right? So one of the things, when you look at your monthly payment when it comes to your house, right? We want to change our mindset of when it comes to the principal. We want to completely change it. And we want to put it in the same category as investment. Investment. It's an investment, right? Like I said, your down payment, right? It's not a cost to acquire the property. It's not going towards insurance to protect your property. It's an investment, or you're converting your dollars into equity in your home, right? That's what it actually is. Your principal is the same thing. When you pay down your principals, you're converting your dollars into equity into the home, which you can at a later date tap back into. So there's a return there. When you rent, there's at no point in time can you go back to the landlord and say, hey, I've been renting from you for 2 years now. I want to tap back into all of that money that I've been paying you in order for me to use it. Or I'm going to leave the property. I want to liquidate a portion of the rent that I've been paying, right? That does not happen. Over here, it does. Let's say you live in this home and let's say you've been there for, I'll call it 5 years, right? 5 years, right? At that point in time, you probably built up somewhere around 15, 25% equity, give or take, right? Not including the appreciation, not including all of the tax benefits of depreciation and mortgage interest that you get, So when we talking about the difference here, there's no comparison, right? You are paying less. Now, you'll say to me, well, Nelson, right? That don't make sense to me. Okay, so let's put it like this. You have a 401k, or you may not, right? But you have a 401k. You have Roth IRA and so on and so forth that's there to gain interest, right? To build your money up, right? Experts and financial planners say, you should try to put somewhere between 3 to 10% of your money that you make away into savings, right? And that's applicable to some or a lot of people out there. But last time I checked, that's not everybody. And there are people that's living paycheck to paycheck. That's one paycheck away from losing everything, right? And there's nothing, I'm not trying to bring down or anything like that. I'm just being a realist here. So what does that mean? Well, if you're in a situation where you're going to pay this amount of money anyway, right? Get home ownership, where you're going to pay that money anyway and start building up equity and ride the appreciation. Now, even if the market crashes, because the market's probably going to crash in the next 2 years, we know supply and demand is going to eventually kick in. There's going to be a market correction, and then there's going to be a bust, right? But once that happens, oh, I lose all my equity in my home, blah, this, blah, that, right? Trust me, the government is going to come through and going to save those that's having those problems. They did it last time in 2007, 2008 crash, and they're going to do it again, right? They're going to come out with programs that's going to allow homeowners to stay in their home, to do deferments, and so on and so forth, right? In order to get back on their feet. But the biggest thing is this: if you are in that situation and you have equity in your home, and the market crashes, now equity disappears, right? There is always a rebound. There's ebbs and flows, ebbs and flows, ebbs and flows, all the way up for infinity. Is kind of how it's going to go. Ebbs and flows all the way up, right? So if you're buying a home and you say, hey, I'm gonna own this home for 5 to 10 years, because a real estate cycle boom and bust is somewhere between 7 to 10 years. And you buy this home and you live in it for 10 years. Imagine if you would have bought your home in 2008, right when the housing bubble burst, right? And now in 2022, your home is worth double. You would have went through that 40% drop, and then you would have rebound, and your money would have doubled itself. Ebbs and flows all the way up. There's no comparison in home ownership, but you don't see that with rent. You don't see rents go down. They don't go down, right? Rents are pretty much even keel, and they just keep going up. But over here, eventually in the long run, this payment could start going down if you know what you're doing. You paid the balance down. Let's say you take 10 years, 15 years, you pay that balance down, right? You can either refinance that into a 15-year fixed mortgage, maybe keep the payments about the same, and now you're going to pay it off even faster, save more money in interest, or put more investment back into your home, or you can refinance it into a 30-year fixed mortgage, drop that payment down, create more cash flow for yourself and your family. If you like this video, please like, subscribe, hit the bell, comment, drop some questions, tell your friends about this. We're going to be dropping a lot of information here, a lot of videos. The next thing, because we covered PITI, we covered the rate. Next thing we're going to talk about is LE and CD. Check the description. We're going to have I have a lot of links in there. There's an inquiry link, so if you have more questions or you want to look at getting the process started for yourself and your family, you can submit an inquiry, and I will get in contact with you. Check out my Facebook group, Facebook page. My social media links are going to be up and updated on all of my videos soon. Check out my book, How to Buy a Home with a Loan. And the more feedback you give me, the better I can put this together and try to address all of your questions and concerns. But ultimately, thank you again for sticking it out with me. This is Mortgage Sensei here. See you on the other side of home ownership.